Hi class, in this video, we're going to go over the chapters on international finance. So first, we need to know something called exchange rate. So you guys probably hear this a lot. So whenever you're buying stuff from other countries or you travel to other countries, you must change your US dollar to the local currency. So for example, then when you go to Europe, you must exchange your US dollar to the euro, or if you go to Japan, you must change your US dollar to Japanese yen. So the different rates, that's called exchange rate. Now the exchange rate depends on different currencies. Some of them are flexible or floating, so it changes all the time, like daily, hourly. Other exchange rate are fixed. So let's say for a couple years, it's always the same rate, right? So they're all called exchange rate. And the reason why we have the exchange rate, I want you to think this back to our trade market, so import export, and especially for import, that if you want to buy stuff from other countries, you have to exchange it for the local currency first. So we're gonna use the dollar and euro for example. So imagine that we have Europe, uh, and then we have US, and then imagine we have a big market in the middle. We call this the the exchange market. So the exchange market, the foreign exchange market, is where the traders and also investors go there to exchange for different currencies. So let's suppose if Europe want to buy, I don't know, an iPhone from America, right? So iPhone is produced in America. Now we all know that's not the case, but let's just suppose. So if a consumer in Europe want to buy the iPhone that's made in America, now the consumer cannot pay the company in America with euro, right? Which just doesn't work because we require dollar here. So imagine you go to your Best Buy, your Walmart, all those iPhones, the price on it is all quoted in dollar, not in euro. So what the consumer would do, they will go to the foreign exchange market, supply the market with euro, and then exchange it back with US dollar, and then with a dollar, they can buy the iPhone from America. So that's what the foreign exchange market does. Allow the consumers and traders and investors to exchange currency from one to another. Okay. Um, Now, exchange rate is the rate and price of which one currency can be exchanged for another. Now normally I don't show you guys examples on the quiz, but let's go over this one question here. So if the US dollar and the Canadian dollar exchange rate is 90 cents US dollar for $1.60 Canadian dollar, how much would a 29,000 USD dollar car cost in Canadian dollars? So what you want to do is to set up a simple cross multiply, right? So we're going to do the exchange rate first. So we're going to do 90 cents US dollar divided by $1.60 Canadian dollar. This equals to US dollar on top, so 29,000 USD over question mark Canadian dollar, right? So and then just solve for the question mark. So cross multiply and then solve for the answer. So that will be what 0.9 times, let's call this x, right? So times x equals to 29,000 times $1.60, and then divided by both sides by 0.9, and then that will be the answer. Okay, you can do the math by yourself. I'm going to do that for you right here. Okay, but just set up a cross multiply and then solve for the unknown variable. And then for the exchange market, there's also a supply and demand for the exchange market. Now the demand side here, so this is whenever we need to have this foreign currency. So imagine that if you have a consumer in America who want to buy a new car in Germany, right? So we need to have this euro, right? So that will be the demand for euro. So the exchange rate of a currency tells us how much unit of another currency it takes to exchange for the foreign currency. And then let's suppose if the price for euro falls. So euro become cheaper. Now, that might sound pretty bad for Europe, but there's one advantage for that. So remember that if we talk about this, let's say a BMW. Now, if a BMW is made in Germany, once the car is produced, it will be quoted in terms of euro. So let's suppose this costs about, 30,000 euro. By the way, EUR stands for euro. Okay. So if your euro exchange rate goes down, so let's suppose before it was here. Let's do 1 euro for $1.05 USD. So which means your 30,000 euro, this BMW in Germany is equivalent to about $45,000. Now let's suppose this changes tomorrow. So tomorrow it become 1 euro to $1. Well, that's good for consumers in America, because this means your 30,000 euro BMW is now equivalent to only 30,000 USD, right? Which is good. This is cheaper now. So what do our consumers do? We're gonna buy more BMWs because they're cheaper now. But if you buy more BMW, so demand for BMW goes up. That also means the demand for euro goes up as well, because we need to have euro to buy the BMW, right? So therefore, between your the price of euro and then the quantity demanded of euro, they're inversely related, right? So price for euro goes down and then quantity demanded goes up. So because they're inversely related, your supply curve, your demand curve for euro is actually going down, downward sloping, just like a regular demand curve. You have the price of euro, which is exchange rate on the vertical axis, and a quantity of euro on the horizontal axis. Okay, so that's the demand for euro, and then for the supply for the currency. So this will be on the other end. So imagine if the price of a euro increases, so euro becomes stronger. So euro goes up. Well, for many of the European consumers, for many of the European consumers, that's a good thing, because if their currency is more valuable, that means they can buy more US produced good, right? But when they're buying more US produced good, they have to exchange the euro to dollar first. So by doing so, they're supplying the market with more euro, right? So on the supply side, we see that when the price for euro goes up, then the quantity supply for euro also goes up, because consumers are now more willing to exchange their euro to more US dollars to buy more US produced good. So there will be an upward sloping supply curve for euro, because this is both the same direction, both positive. So your demand curve is going down for euro, your supply curve is going up for euro. Now, once these 2 points intersect, you're gonna have your market exchange rate for euro, and also your equilibrium quantity for euro. So how much is the quantity of euro in the market? Okay, so that's the foreign exchange market. It's also determined by supply demand, and then which means it's also subject to any type of supply demand changes. So there are two type of foreign exchange rate. There's a flexible exchange rate. There's also a fixed exchange rate. So we're gonna talk about flexible first. So for flexible exchange rate, now we're gonna start with something simple, right? So if you just do a simple shift, so let's suppose for this market, there is a higher demand for BMWs, right? Because suppose America consumers love BMWs, higher demand for BMWs, which means higher demand for euro, so demand goes up, and then what you're going to see is that the exchange rate for euro also goes up, right? So it goes from $1.25 to somewhere between $1.60 or so. And then if you want to think a step further, what that actually does to the market, that because the US consumer love BMWs, there's a higher demand for BMWs, which causes the exchange rate to go up, which causes the price of BMW to increases. So eventually it will go back to the equilibrium, right? But at least for the short run, that when this happens, this will cause a upward shift of our demand curve, and then we're gonna see appreciation of euro. And then vice versa, let's suppose there increased supply of euro on the market. So let's suppose, for many of the European consumers, they all love wine from California, and then they all buy wine from California. Right? So there's a bigger supply of euro in the market, then you're going to see a devaluation or depreciation or devaluation of the euro compared to US dollar. All right, so a couple of things you need to remember, very importantly, is that whenever this exchange rate changes, it will have an impact on the trade market, right? So if your exchange rate becomes cheaper, so like the one we saw over here, the exchange rate goes down, this is good for your export market. That means everything produced in Europe is now at a lower exchange rate, so they're cheaper now, right? You can sell more good, and then vice versa. If you have a increasing exchange rate, this can be very bad for your export market, because at a higher exchange rate, let's say for BMWs, their car just become more expensive for US consumers because now they're at a higher exchange rate, right? So this exchange rate, whenever it happens, it will definitely cause a change in your trade market. So it will make the import export either cheaper or more expensive. Now, if you want to see a more complex shift of your foreign exchange market, so combine two shift together. So over here we have our demand for euro goes up, supply for euro goes down. And then guys, for this type of questions, I want you to remember what you learned before in the regular supply demand curve. That whenever if you see supply increases, price goes down, quantity goes up. Supply decreases, price goes up, quantity goes down. Demand increases, price goes down, price goes up, quantity goes up, and then demand goes down, demand decreases, price goes down, and then quantity goes down. Right? So for the question we have here, we're gonna see a demand increase and then supply decrease. So a demand increase, that'll be this one right here, and then supply decrease, right? So combine them together, then what you're gonna see an increase in the price of euro, so appreciation of euro, but the change in quantity is uncertain because you have one going up, other one coming down, right? So it's uncertain. And then now for the graph over here, even though you're going to see an increase of quantity, but this is just one of the possibilities because you see how the two lines are shifting by different amount, right? So it depends on which one shift more, your answer will be different. Now, vice versa, if you reverse it, if you do supply increase and then demand decrease, so let's go back over here. So it's a supply increase and then demand decrease. Then what you're going to see is that for the prices combined together, price will go down. But for quantities, because they're working against each other, the quantity change is uncertain. It depends on which one change more. Okay. All right. Now for fixed exchange rate. So fixed exchange rate means doesn't change, right? It's always the same. But naturally, this doesn't happen. That means there gotta be some interventions by the country's government or the country's central bank to force the exchange rate to be fixed at a certain point. Now we have example here is the Thai currency. It's called a Thai baht. So for a long time, this is in the 1990s, the Thai baht was fixed to US dollars. Now to make that happen, that means naturally that when the Thai economy was growing, that when there were more trade between US and Thailand, there was a higher demand for Thai currency, for Thai baht. So if nothing happens, then this will push the value for Thai currency, Thai baht, to a higher level. So you go from 0.1 to 0.2. But the Thai central bank doesn't want that to happen, because if you go to 0.2, even though it's a very high value for Thai currency, but that will make everything produced in Thailand more expensive. So Thai company actually lose competitiveness when they're compared to other countries, right? So what the Thai economy decide to do, that they're going to increase the supply of Thai baht, right? So supply goes up, and then this will push the currency value go down a little bit, so go to 0.3, and then you are staying at the same level as before. So that's how the central bank can use the exchange rate policies to fix the currency value to another currency. Now, the reason why we're using Thai, for example, here, if you guys are interested, look up the 1997 Asian currency crisis. It really started in Thailand and also spread out to other countries such as Philippines, Indonesia, Malaysia, and also very importantly South Korea. So many of those countries suffered very badly. That they saw a huge devaluation of the currency. That was because they would try to peg the currency to the US dollar before, but they couldn't keep up, and then everything fell down as a snowball effect. Okay, but if you guys just look up the 1997 Asian currency crisis, you can read more information about it. Now there are two ways the central bank can increase money supply. Now we learned one of them before, is to pursue expansionary monetary policy, so which means offer more lendings to the economy, or just by printing out more cash. The other way, this is new to this chapter, the central bank can increase money supply, is to buy foreign reserve with your own currency. Now this foreign reserve, think this as US debt, so US government bond. So if the Thai central bank is buying US government bond, they're going to pay for it with the Thai baht. And this actually increase the supply of the Thai baht. Right? So there are more Thai baht in the world market. So again, imagine that so between Thailand and US, we have this exchange market. And then Thailand want to buy more US government bond. Now, what they must do first? They must supply the market with baht. They will in exchange getting US dollar back, and then use US dollar to buy the bond from America, right? So therefore, there are more baht in the exchange market, so supply increases. Okay, so that's increase in money supply. Not in the sense of the individual local economy in Thailand, but in the global economy, there are more baht available to exchange for US dollars. Okay, and then vice versa, if you try to decrease your money supply, you do the reverse, right? So you do contractionary monetary policy, or you're gonna sell foreign reserves to getting back your own currency. Okay. All right, so next concept is called a balance of payment. So for balance of payment, think about the inflow and outflow of your currencies. So for balance of payment, it means that your inflow of your own currency is equal to your offload of your own currency. So therefore, if you take the now again, there are different signage, right? So inflow is coming in, outflow is going out. So if you see that, suppose we inflow is $300, and the outflow we have a minus $300. So if you take the inflow 300 plus the negative outflow, then if it's balanced, you're gonna see a 0 at the very end. Right, that's called a balance of payment, right? So how much your inflow amount equal to how much your outflow amount. Now, guys, I'm going to use my own notes here, for example, because your textbook, the information is slightly a little different than most textbook informations on this chapter, on this topic. That normally there are two accounts for balance of payment. You're going to have your current account, and then your capital account. Now, capital account is also called the financial account. Okay, but in your textbook, they actually list them separately, but normally it should be the same thing. So current account, this is your trade. So this is the cash inflow, outflow coming from the trade market. So export and import. Now, when you are exporting this good, that means you are getting money to the economy, right? So we're selling our U.S. produced, Harley Davidsons, our U.S. produced California wine, Texas steak to other countries. That means we're getting money to U.S. economy. Now, if you're importing, you're losing the money, right? Because if you're importing, that means you're paying money to somebody else. That's cash outflow. Now, for the capital account, we're looking at buying and selling of asset. Now, this asset can be anything. This can be your individual house, stock and bond, or companies. So those would be the asset, right? And then for this import-export asset, we're looking at different consumers, or different investors. So you might have foreign investors, and U.S. investors. Now, for foreign investors, when they're doing transaction in America, so imagine if you have somebody from, I don't know, maybe Canada buying a house in America, there's a cash inflow for America, right? And vice versa. Let's suppose if you have a U.S. consumer buying a home in Canada, there's a cash outflow in America, right? So away from America, right? So that's a direction for your current account and capital account. And then for this balance of payment, we're saying that your current account plus your capital account equal to 0. Okay, so one example that the book gave it to you. So let's suppose that if your export is what is this, $500, your import is $800, and at the same time you have so you have an investor from China. So China buys U.S. government bond. Buys U.S. bond for $300. All right. So what you have, this is positive because that's an inflow of cash. This is negative. That's an outflow of cash. Plus, now China buys U.S. bond. This is the foreign investor buying something from America. That's positive. That's cash coming into America. So that's positive. and this is equal to 0. Okay, so therefore the payment is balanced. That's called balance of payment. Okay, so your cash inflow, your total cash inflow is equal to your total cash outflow. Now that is what's happening between US and China. That every year, so US is selling a little bit of export to China, but we're buying so much more import. At the same time, we're getting the money back when China is investing the money back to US economy. So that's either by US government bond, or they can also buy other assets such as properties, companies, or stocks. Okay, and then this is a big part of it. So now many of the stock investors from China, they're now getting money to America. Okay, the thing that's also similar to properties, you do see more and more Chinese investors coming to America buying homes in America. So don't be surprised if you see your new neighbor is someone from China and they pay cash for the house because they're getting money from China. Okay, all right. The last part for this chapter is the surplus and deficit. Okay, so they just talk about what is the trade surplus is and what's the trade deficit. So trade surplus is anytime your export is more than import, you have a trade surplus. And then a trade deficit is anytime your export is less than import. That's called trade deficit. So right now for US economy, we have a trade deficit with China because we have more import than export. Okay. All right. So guys, that's it for this chapter. Have any question, let me know. Okay. Good luck. Bye-bye.